everyone, we're back again for actually round two with Kumail, and this time we're going to touch on commercial mortgages with Kumail and get his expert advice on how to move along with any one of you who's going to get, let's say, a commercial financing. Kumail?
Yeah, so thank you again for having me. And like I said, we've done commercial financing, which would include mortgages and various different types of loans.
Okay.
For 20 years plus. Mm-hmm. And we are independent in terms of helping clients place their business for loans with various lenders, whether it is banks, equipment lenders, private lenders, or some specialized lenders.
Okay. And how would you say is credit important when it comes to huge commercial loans? So these are starting at $500,000 and up?
Yeah, usually commercial loans start $500,000 on unsecured credit, meaning unsecured is what we call, it has no hard security like an asset backing it. So for example, it's not a property or your residence that's backing the loan, it's just your company, right? So the history of your company,
yes,
or your business, the financial strength of your company, okay, backs the loan.
Okay.
So credit, as you said, if we are touching that, it is important. Yes. So for example, if somebody had a bankruptcy,
yeah,
that would potentially rule you out for obtaining a commercial loan. But if the business is strong, mm-hmm, and there is some kinks in the credit history, mm-hmm, you can still overcome it depending on providing a good rationale.
Okay.
Yeah.
Okay. So in this, again, can we touch on what would be, so this would not be secured loans, this would totally be falling under unsecured?
Well, depending on the type of loan again, because commercial, okay, financing is very customized. Every business is different,
okay,
right? So every business has different requirements. So they actually, you have to submit information about the business. Yes. There is some key information that every bank looks at or every lender looks at.
Okay.
And so depending on the financing you require, some of it may be underpinned by an asset, like a property. So for example, okay, if you want to obtain a big commercial property, yes, and get a mortgage on it, then that's backing the mortgage, right? The property will back the mortgage. If you have equipment that you need to require, to run the business, then that equipment is going to back the loan, okay, right? No. But if you're going to acquire another business, yes, right? It may be a service-based business.
Yes.
That is called a cash flow loan. Okay. Meaning that really the banks or the lender is advancing a loan based on the strength of the business you're acquiring and your business, right? So businesses that don't have assets or are not typically heavy with assets, okay, they can be acquired without, hard security.
Hard security. Okay.
Yeah.
Okay, that's interesting. So again, who are the lenders? Like for us in residential, we've got, mm-hmm, the major banks, and then I've got alternate lenders too. So right, is it the same for you guys in commercial? Absolutely,
right? Okay. So they're depending on the requirements of the client.
Okay.
Right. So you could have banks lending you. Mm-hmm. Normally banks are the cheapest,
yes,
source of capital.
Yes.
Right. But their requirements or their thresholds for approval are quite high.
Yes.
And you have to abide by a lot of covenants. Covenants meaning, rules, for example. So you have to submit financial statements every year, yeah, or depending on the size of your loan, you may have to submit reporting every month, because the loan is so reliant on the business, yeah, that they have to make sure by regulations, mm-hmm, that the business is running and able to support the loan that it has to pay back. So it may require additional monitoring, yes, right? So what I mean by covenants is it could be reporting covenants, it could be financial covenants, and various other covenants depending on the situation, right? So that's the bank. then you would have the credit unions.
Yes.
Right? And typically credit unions focus on mortgage lending.
Yes.
Right? And their criteria, they can do loans that perhaps banks cannot. They can reach further in terms of types of properties they'll finance. But now some credit unions are also looking to grow and are able to offer full banking relationships.
Okay.
So they can also offer financing in non sort of mortgage areas. Then you have equipment lenders.
Yes.
Right? So equipment lenders are just focus on equipment. And again, within that, there's a lot of specialization. So some lenders focus on just some medical equipment.
Yeah.
Some focus on manufacturing equipment. Some focus on vehicles.
Yes.
Right? So as you go further down, you become more specialized in terms of the lenders.
Okay.
Right? So banks can lend across the board.
Yes.
Where credit unions kind of have a narrower scope. And as you get to equipment and other private lenders, the focus is narrower.
Okay.
Right? So depending on what the business needs, you can go to the right source of capital.
Okay.
And and then present it.
So typically, how long? What is the process that it takes you to acquire a commercial? Because I'm sure it's not as easy as residential mortgage.
Yeah. So there's a few things that make a commercial loan. It takes somebody longer to acquire a commercial loan.
Okay.
Because it's so customized.
Yeah.
And it's based on your business.
Yeah.
So if a lender does not understand or has not seen your business before,
Yeah.
they need to understand your business.
Yes.
So, they would look at many pieces of information.
Mm-hmm.
For example, they'd look at financial statements. They will look at part of it, personal credit, right? They will look at your customers. They will look at your suppliers.
Yeah.
Right? So what the businesses do, what the business has to do is submit all this information so the bank can do what you call a risk assessment. Right? So typically the financial information is used to come up with a risk rating, which is equivalent to a credit score.
Yes.
In the residential world,
Yes.
right? So they put it into a system where you are the information is lined up against industry, against your competitors, against a lot of data, and the result that comes back is a risk rating. Okay. Based on that risk rating, a lender will assess the price of the loan, the structure, meaning what do they need to advance the loan, so do they need more covenants, do they need more security, right? Or if you're doing a term loan, for example, you're buying equipment or you're acquiring another company, do they need a longer amortization, a shorter amortization?
Okay.
Right? Is it something that they need like monthly reporting on?
Yes.
So, for example, if you have a line of credit, can they give you a line without any monitoring? Or is it something that needs to be monitored?
Okay.
Right? So they take a lot of information and assess the risk, and then based on the risk, they develop what you would call an offer or an approval that has to meet certain conditions.
Okay, perfect. And usually in your world, I guess once they give you the intent, a client is usually required to pay a deposit most of the time.
Yeah, so let me go back. You asked how long does this take?
Yes.
So that's a very good question, and I did answer it, but I will touch on that through the next few sort of sentences. So once you go in, you submit all the information.
Okay.
The bank or the lender will give you what you call either a term sheet or letter of intent or a discussion paper. So basically that's an offer.
Yes.
Right? Once you get the offer, you try and you review it, and if you like it, you sign back.
Yes.
Right? You sign back and tell the lender, yes, I want to go for an approval.
Okay.
Right? So typically, to get to the offer stage, if you've provided all the information that a lender needs, about 10 business days. Okay, so 2 weeks. give or take.
Okay.
Right? If it's a bigger file, if it's more money, more complex,
Yes.
it will take longer.
Okay.
Because typically banks or lenders don't want to give you an offer that they can't deliver on.
Okay.
Right? So the more information you provide, the better your business presentation,
Yes.
the faster the offer,
Yeah.
and more deliverable or comprehensive.
Okay.
Right? So when you get an offer, you don't want to get an offer with a whole list of conditions that you have to satisfy. That means every condition that you have to satisfy could potentially be something that the lender may not like.
Okay.
Right? So the better to provide all the information, package the deal. It's more efficient,
Yes.
and it's easier for the lender to assess and get back to you quickly. So that's 2 weeks. And then once you sign, and you have to pay a fee because the lender just wants to make sure you're not shopping the financing around.
Yes.
Because now for them to get the approval, it's a lot more work.
Yes.
Right? Because it doesn't involve only one person. It may involve 2 or 3 people.
Okay.
Right? Because there might be an approval committee. So they're spending their time in order to get you a
acquire
loan.
that, yeah.
So they want a commitment fee. Now the
Okay.
commitment fee could range.
Yeah.
We'll get into that later. But the timing on that, again, another 2 weeks, let's say.
Okay.
So that's 4 weeks in total to
Yes.
get an approval.
Okay.
That's a good case.
Okay.
Right? Where everything's been provided, everything's clean, there's no additional questions, right? They didn't come up with something that anybody was not aware of,
Yes.
right? So, so 4 weeks to get an approval is pretty good. Okay, and then next thing is legal. So legals are very important because when you get an approval, you have to meet certain criteria.
Okay.
Right? So the legal part is very important because the banks or the lender will register security on your company and the assets. Now, if you have a complex setup, the legal process will take longer. If you have one company, one owner, right?
Yes.
And one, just say one registration,
Yes.
and you don't have a lender there, or you may have a lender, then you're swapping one lender for another, then it's a fairly straightforward process, but that could be 2 to 3 weeks.
Okay.
So, I mean, all in all, you're looking at maybe 6 to 8 to 9 weeks, depending on, how complex the financing is.
And then,
Right.
then comes also environmentals, right? That plus the appraisal.
Yeah, but that
takes-
depends on what you're trying to do. So, for example, if you're trying to do property financing,
Yeah.
environmental, meaning contamination, is a big concern.
Yes.
Because your property may be located
Yes.
on land that may have been previously used by a party that contaminated it,
Yes.
or around you. It's also some people, or some clients may not understand, but surrounding that property
Yes.
may be businesses that are conducting activities that could contaminate your property.
Yes.
Right? So typically lenders want a phase 1 environmental assessment
Yes.
to initially assess whether there was actually this presence of contaminants, or there is the potential for that property to be contaminated by activities around that property.
Okay.
Right? So this typically only happens in mortgages, or
Okay.
unless you're operating a property that you're borrowing a lot of money for,
Yes.
and you could potentially contaminate it or the surrounding area, and the banks or a lender does not want to be held liable, or be sued later
Yeah.
if they willingly lent money, knowing that there was a risk of contamination.
Okay.
Okay. The second thing on the property is, just to cover everything in that sector, is that you need an appraisal.
Okay.
So appraisal just gives you, in residential you have an appraisal, it just gives you a value of the property, an independent value of the property.
Yes.
And typically you have to hire a qualified appraiser to conduct, and they're usually commercial appraisers are different from residential.
Yes.
And if you go to environmental,
Yeah.
then you need to hire an engineering firm that focuses on environmental. So every lender has an approved list So when you go to a lender, if you're working with one lender, you want to make sure that you're using somebody on their approved list.
Okay.
You know, because they are comfortable with that appraiser or environmental engineer, and you know they know they've vetted them.
Yes.
So it's better to use somebody on the approved list.
Okay.
Right? And then, if again, sticking to mortgages, the third report, and as you can see, it gets more complex, is a structural report. So structural meaning a building engineer will go and assess, you know, various aspects of the building. So, you know, how long is the useful life of the building, right? If it's a 10-year useful life, then maybe they will not give you a 25-year mortgage, or 25-year amortization. Okay. You know, or maybe, you know, so that's just to make sure the building has the ability to, you know, sort of be sound. Yes. From a capacity perspective. So if you're going to conduct certain activities in there, you know, make sure that it's safe to do that, right? Because if something were to go wrong structurally, you know, then either it costs a lot of money to fix it, or it could lead to, you know, safety issues, which no lender wants to be involved in or tagged on, right? So everything I've told you adds time to the process. Yes. An appraisal takes 2 to 3 weeks, depending on how busy the appraisers are. Yes. Right? An environmental report, again, 2 to 3 weeks. Okay. Right? And a structural report, up to 2 weeks. Right?
So let's say it takes about, all in all, sometimes it could be at least, I would say, 3 months.
3 months, but typically once you engage these, you know, these firms, this process are run in parallel. Yeah. So meaning that, you know, it doesn't add time if everything's run together. The reports come pretty close together. Yeah. And provided there's no issues, you know, then you know it should be it should close, or you shouldn't add more delays to the process.
To the process, okay.
Yeah. So that's mortgage financing. Okay. Obviously, every type of loan in business has different sort of assessment criteria, you know, different sets of documentation or reporting to look at, right? So again, what we do is when we get a request for a loan, we make that assessment, right? Okay. And then we'll go to a lender based on what we think is sort of the right loan sort of type, structure. So we kind of reverse the process. We'll go to a lender and tell them what we want, rather than letting a lender telling us this is what
we can give
you. And we support all that, you know, by doing a full analysis, a write-up, you know. Okay. Whether if it's in small business, we'll do a business plan, or if it's a commercial, we'll do a loan proposal. Okay. Right? So it's written in the language of the banks or lenders, so they understand and can quickly make a decision.
Okay. Yeah. Well, that's good to know. Just a last question I had for you is, I know you were telling me about, you know, if a client's gone through bankruptcy personally or something with, let's say, if a client was in bad shape, lost his business or whatever, let's say the bank was, for example, TD. Now he's starting to build, it was a personal, you know, emergency situation that happened in his life. So now he's starting to get up again. Do you think he can go back to the same lender, or would they even look at him like, or would you tell people that it's good to go to another bank usually?
Well, so typically in that situation, if as a result of the bankruptcy, the bank was negatively affected, right, then they would not want to deal with that client again.
Okay.
No, right? So it could be 10 years or a long time ago. Yes. But that information is retained within the bank system.
Okay.
So typically banks don't want to. And then you may be better off if you've had an issue with the bank. Yes. But if you go to the next bank or another bank, you have to explain the situation because that history will come up. If not, and the credit, because I think the credit report keeps that information
for 6 years.
6 or 7 years until you get discharged,
yeah.
right?
Yeah.
So once the mortgage gets discharged, once the bankruptcy is discharged, then there's no history on the credit report.
Yes.
But banks conduct a lot more due diligence, especially at the legal stage.
Okay.
Right? So they can go and check the court records, they can go and check various other records that gives them a history. So in that circumstance, it's better to have full disclosure with the lender.
Okay.
And give them a rationale.
Yes.
And, and lenders are very understanding in many circumstances because they do realize bankruptcies do happen.
Yes.
But as long as, the circumstances surrounding that bankruptcy are not repeated.
Okay.
So, again, it is a hurdle that you have to overcome.
Okay. Okay.
Yeah.
Anything else you'd like to let our viewers know on commercial mortgages?
Yeah, well, it's a complex process.
Okay.
And even a lot of businesses who have never borrowed or have very simple borrowing requirements, and as they get bigger, they have more complex borrowing requirements.
Yes.
They may need some help. So it's good to, first of all, get that check done and understand that, okay, is this the right thing to do? Will it qualify before spending all the effort and going in and getting financing? So it's
commercial pre-approval is what I would say.
Well, I wouldn't say it's a qualification. Yes, you'd qualify for this loan, but approval is again, it's a multi-step process.
Yes.
Right. So the underwriters, or what you call the credit managers that do approve the loans, you're never going to interact with them.
Yes.
Yeah. So having us tell you that you qualify doesn't get you an approval, but it's the probability of getting an approval increases.
Yeah, but you cover all the preliminary steps, right?
Yes.
To ensure what the bank is going to want to know about the client, and I guess that makes it smoother than the client approaching the lenders on their own and not getting the job done.
Yeah, I mean, typically, we would help you get the process done faster.
Yes.
Maybe better rates, better structure, and smoother process.
Smoother process. Yeah. Okay. Thank you so much for listening out to us again. And again, if you have any questions in regards to commercial mortgage, anything related to even small business loans, please feel free to reach out to Kumail Hasan. I'm going to have his information below for you guys. And thank you so much, Kumail, for joining us.
Thank you. Appreciate it.